Hi, this is Trevor. In this video, we're talking about construction loans, or more specifically, the main differences between conventional purchase and refinance loans and construction or renovation loans. The qualifications are different, the requirements are different, and it's much more difficult to get a construction loan than it is to get a conventional loan. I also have a lot of the forms necessary to apply for a construction loan. By the end of this video, you'll understand all of the main fundamental differences between purchase and refi loans and construction loans. Conventional purchase and refinance loans are almost always on existing cash flowing assets, whereas a construction loan is specifically for the purpose of building or developing a piece of land into a cash flowing asset, or redeveloping it into a higher and better use. The first and most significant difference between a conventional loan and a construction loan is that a conventional loan, the borrower receives all of the money up front, either to complete the purchase or to pay off the old loan or to receive cash out. Whereas a construction loan is set up sort of like a line of credit. It's on a draw schedule. In a construction loan, the borrower does not receive all of the loan amount all at one time, nor do they pay interest on the entire loan amount from the beginning. They're only paying interest on the portion that has been drawn down off the construction loan. So each time the borrower completes a phase of construction, they're able to draw that portion of the loan down, pay off their subcontractors, potentially take some for themselves, and then continue moving on. Conventional loans can come in a variety of forms. They can be fixed rate loans, variable rate loans, or they can be hybrid loans, which is a combination of the two, say fixed for a few years and then variable for the remainder. Whereas construction loans are almost always variable rate loans. They fluctuate with the market interest rates or whatever index that the lender is using to base their construction loan rates on, but it's extremely rare that you can find a fixed rate construction loan. The down payment required by a lender with a conventional loan is typically lower than that is required for a construction loan. It's not uncommon to see conventional borrowers able to get a loan with just say 5, 10, or 20% down. But in construction loans, the lender is typically going to require that the borrower have 20 to 30% or more as a down payment, and they will finance the rest. And this is because construction loans are perceived as higher risk, and they want the borrower to have more skin in the game. When it comes to a net worth and guarantee requirement, conventional loans have a lower threshold than construction loans. It is actually even possible to get a conventional loan that does not even have a personal guarantee attached to it, also called a non-recourse loan, where the lender's only security is the property itself. Non-recourse loans don't exist in construction loans. The borrower is going to have a net worth that is at least equal to the loan amount, so that if the lender decides that they need to foreclose for whatever reason, they can go after the borrower personally or the borrowing entity and recover those funds. So in the case of a construction loan, the borrower is going to have to demonstrate that they have a net worth equal to or greater than the loan amount in order to qualify for the loan. When it comes to risk, lenders typically perceive conventional purchase or refi loans as low risk. There's a cash flowing asset there that they can take control of if the borrower defaults on the payments. Whereas a construction loan is regarded as extremely high risk. There are an infinite number of things that can go wrong with a construction loan. For example, the price of lumber could skyrocket. There could be a shortage of materials somewhere in the global supply chain. Interest rates could fluctuate. The borrower could become insolvent, run out of money halfway through the project, and then the lender would have to take over and either finish the project or try and liquidate it half complete. Therefore, the underwriting is more thorough, the inspection process is much more diligent, and generally speaking, construction loans are going to be harder to get and definitely more expensive than your average conventional loan to purchase an existing asset. When talking about payments, a conventional loan always has payments. They can be principal and interest payments, or sometimes interest-only payments, or frequently both. But no matter what, there are going to be payments required on the loan. Payments are not always going to be required in a construction loan. Sometimes those payments can be built in, so the builder does not have to make those payments. They're just included in the loan. There's still interest but at least it doesn't impact the cash flow that the builder could be using to invest in the project. In terms of flexibility, conventional loans typically don't have that much flexibility. It's just a one-time loan with an interest rate, a payment, designated terms. They're fairly straightforward. Whereas a construction loan can have a lot of flexibility. It can be structured with payment terms or interest-only payments. A construction loan can have a mini perm element where it's a construction line of credit in the beginning, which converts to a short-term permanent amortizing loan, giving the sponsor a little bit of time to hold the property before they have to refinance. Construction loan terms can vary wildly compared to a conventional loan. There's room for a lot of creativity and for a lot of negotiation. So it's important to remember that not all construction loans are the same. In terms of maximum loan amounts, conventional loans are capped on a loan-to-value basis, or LTV, and that is the loan amount divided by the value of the property. With construction loans, that same metric is used as loan-to-cost, or the loan amount divided by the cost of building the project. Both of them are speculative, but at least a construction budget can tell the lender how much the project is going to cost to build, and then the lender can decide what percentage of that cost they want to loan. Conventional purchase and refi loans can be either long or short-term loans. Construction loans are short-term loans. They are specifically designed to finance the construction of the property until it is complete and often leased up and occupied. But a construction loan is not designed to be a long-term loan. The lender who is financing the construction loan is typically wanting to be paid back through the process of refinancing. So if you're a real estate investor that's even considering building on your land, I strongly recommend that you get a construction loan approved prior to moving forward. A lot of real estate investors that want to become developers are often shocked at how difficult it is to get a construction loan, and a lot of people end up buying land they can never build on without taking on another partner and giving away a bunch of the project. If you still have questions, contact me at evergreen.llc or reach out, put a note in the comments, and thanks for watching.